Most people see market crashes as a disaster. Portfolios drop, headlines turn negative, and fear spreads quickly. But experienced investors often view these moments very differently. Instead of only focusing on losses, they pay attention to how prices disconnect from long-term value, where quality assets become temporarily undervalued, and how emotional selling can create unusual opportunities. Today we will talk about how investors turn crashes into opportunities. So before we get started, make sure to hit that like button, also subscribe to my channel. 10. Most people see crashes as the end of wealth building. When markets crash, the average reaction is fear. People check their portfolios constantly, panic about losses, and assume something is fundamentally broken in the financial system. For many, a crash feels like the worst possible moment to do anything with money. But experienced investors see something very different. They understand that crashes are not just periods of destruction. They are also periods of reset. Overpriced assets lose value, speculative excess disappears, and emotional trading temporarily dominates rational decision-making. In that environment, opportunities quietly begin forming for those who are prepared to think differently. 9. Crashes reset overvalued markets. One of the most important roles of a market crash is correcting overvaluation. During bull markets, prices can rise far beyond what businesses or assets are actually worth, because optimism and speculation take over. Eventually, reality catches up, and prices fall back toward more reasonable levels. While this feels painful in the moment, it also creates opportunities. Assets that were previously too expensive become more reasonably priced. Strong businesses may still have solid long-term fundamentals even after their stock prices fall significantly. Investors who understand valuation cycles recognize that crashes often restore balance to markets rather than simply destroying value. 8. Fear creates forced selling and mispricing. During crashes, many investors sell not because they want to, but because they feel forced. Emotional panic, margin calls, liquidity needs, or uncertainty about the future can push people to exit positions quickly. This forced selling often leads to mispricing, where assets trade below their long-term worth. Experienced investors pay close attention to these moments because they create temporary inefficiencies. When emotions dominate decisions, prices can disconnect from underlying fundamentals. This gap between price and value becomes the foundation for long-term opportunity. 7. Long-term value does not disappear in a crash. A common mistake during downturns is assuming that falling prices mean falling value. In reality, price and value are not the same. A strong business may continue generating revenue, maintaining customers, and growing long-term potential even while its stock price declines. The same applies to other asset classes. Crashes often reflect short-term fear rather than permanent destruction of value. Investors who focus on long-term fundamentals instead of short-term price movements are better able to identify which assets are temporarily undervalued versus those that are truly broken. 6. Cash becomes a strategic advantage. One of the most important tools during a market crash is liquidity. Investors who hold cash or liquid assets during stable or booming markets gain flexibility when downturns arrive. While others are forced to sell at low prices, prepared investors can deploy capital strategically. Cash is not just a defensive position. It becomes an offensive tool during crashes. It allows investors to act when opportunities appear, instead of reacting emotionally under pressure. This is why disciplined investors often prioritize maintaining some level of liquidity even when markets are performing well. 5. Emotional cycles create predictable patterns. Financial markets are heavily influenced by human psychology. Fear and greed repeat in cycles across every generation. During crashes, fear dominates and causes widespread pessimism. People assume conditions will continue worsening indefinitely, even when historical patterns suggest recovery eventually occurs. Investors who study these emotional cycles understand that extreme fear often appears near market bottoms. While timing exact turning points is difficult, recognizing emotional extremes helps investors think more rationally when others are reacting emotionally. 4. Strong assets rarely lose long-term demand. Another key principle during crashes is separating temporary price declines from permanent demand destruction. Many strong assets continue to have long-term demand even if short-term prices fall. High-quality companies, essential services, productive infrastructure, and real-world assets often recover because their underlying usefulness does not disappear during a downturn. Investors who focus on long-term demand trends are better positioned to identify opportunities where temporary fear has created disproportionate price declines. 3. Crashes reward preparedness, not prediction. Many investors try to predict when crashes will happen, but even professionals rarely get timing exactly right. Instead of focusing on prediction, experienced investors focus on preparedness. This includes maintaining diversification, managing risk, avoiding excessive leverage, and building financial flexibility. When a crash arrives unexpectedly, prepared investors are able to respond calmly instead of being forced into panic decisions. Over time, preparedness tends to matter more than perfect timing, because it allows investors to survive downturns and take advantage of opportunities when they appear. 2. Wealth is often transferred during downturns. Market crashes often act as wealth transfer events. Assets move from emotional sellers to disciplined buyers. Investors who panic may lock in losses, while investors who remain rational can acquire assets at significantly lower prices. Over time, these cycles contribute to long-term wealth accumulation for those who consistently stay patient and strategic during downturns. This does not mean crashes are easy or comfortable, but they often reshape ownership in financial markets as confidence and liquidity shift. 1. The real reason investors turn crashes into opportunities. The deeper truth about market crashes is that they are driven by emotion as much as economics, because the truth is simple. When fear becomes extreme, investors stop focusing on long-term value and start prioritizing short-term survival, which can push asset prices far below their actual worth. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.